Today, we will talk about gross earnings, definition, examples, versus net earnings. Gross earnings is the total amount of income earned over a period of time by an individual/household or a company. For individuals and households, gross earnings is the income earned before the deduction of taxes or adjustments. In the corporate world, it's an accounting convention that refers to a public company's gross profit or the amount left from total revenues over a specified time period once the cost of goods sold is deducted. Gross earnings are also commonly referred to in the financial sector as gross profit or gross income. As noted, the term has different meanings depending on how it is used. When referring to personal or household income, gross earnings are generally the first line of an employee's pay stub, followed by income and payroll taxes and other deductions. Once these deductions are accounted for, the employer lists the employee's net earnings or income on the bottom of the pay stub and on their paycheck. When it comes to the business world, the term refers to the amount of money left from a public company's total revenue once the COGS is deducted, also known as gross profit. It is the income a company earns before any adjustments and other deductions. A company's gross earnings are reported periodically on its income statement. The first line of the income statement reports a company's total sales and revenues for a given time period, while the COGS and gross earnings often appear on the second and third lines. The difference between revenue and COGS is a company's gross earnings. Once a business calculates its gross earnings, it may subtract the rest of its business expenses, including costs such as utilities, loan repayments, office supplies, and many other expenses. For tax purposes, the Internal Revenue Service distinguishes gross earnings and adjusted gross income, AGI. Gross income includes all of the money you earn through the year including wages, income from a business, alimony payments, rental income, interest, and a few other types of payments. The IRS allows taxpayers to take a select number of above-the-line deductions from gross income, and these include certain expenses incurred by educators, eligible moving expenses, contributions to IRA accounts as well as a few others. To understand individual gross earnings, consider Mr. Z, who earned a total of $50,000 for the recently completed fiscal year. He also paid $10,000 in income tax, retirement contributions, and Social Security payments. In this case, his gross earnings are $50,000, and his net earnings are $40,000. But how does it work for businesses? Here's a simple example. Let's say Company X has sales of $2 million, cost of goods sold of $500,000, and expenses related to the sale of $300,000. The company's gross income is $1.5 million. After the other deductions, it is left with $1.2 million in net income. For a business, gross income is the difference between revenues and cost of goods sold, whereas net income is the difference between gross income and all other business costs, such as taxes. Yes, total gross income is your salary. It is the amount of money you have before taxes and other adjustments are deducted. For example, if you had an annual salary from your employer of $100,000, that would be your gross income. After taxes and other adjustments, you take home $65,000, which is your net income. Here are 5 key takeaways. 1. Gross earnings is the total amount of income earned over a period of time by an individual/household or a company. 2. The gross earnings for a person or household is any income without any deductions. 3. For a business, gross earnings is the total revenue less the cost of goods sold. 4. Gross earnings are also referred to as gross income or gross profit. 5. The IRS differentiates between gross earnings and adjusted gross income, which is what is left over when certain above-the-line deductions are subtracted. Hope this would help. Thanks for watching.